Question 1. Governance review demonstrates that the insurance company has identified a range of operational risks. Which of the following approaches to prioritizing these risks for mitigation best aligns with regulatory expectations and sound operational risk management principles? Option A. Prioritizing risks based on a comprehensive assessment of their likelihood and potential impact, aligned with the company's risk appetite and regulatory requirements. Option B. Prioritizing risks based on the ease of implementation of mitigation controls. Option C. Prioritizing risks based on the volume of internal stakeholder complaints. Option D. Prioritizing risks that have recently materialized, irrespective of their inherent severity or likelihood. The correct answer is A. Prioritizing risks based on a comprehensive assessment of their likelihood and potential impact, aligned with the company's risk appetite and regulatory requirements. Explanation. Scenario analysis. This scenario presents a common challenge in operational risk management within an insurance company, balancing the need for robust risk mitigation with the practicalities of resource allocation and business operations. The challenge lies in identifying which operational risks, despite their potential impact, are genuinely the most critical to address first, given finite resources and the dynamic nature of the insurance business. A failure to prioritize effectively can lead to wasted resources on less significant risks or, conversely, leave the company exposed to catastrophic events. Careful judgment is required to align risk management efforts with the company's strategic objectives and regulatory obligations. Correct approach analysis. The correct approach involves a systematic evaluation of identified operational risks against established criteria, such as likelihood and potential impact, financial, reputational, regulatory, and operational. This evaluation should be informed by the company's risk appetite framework and regulatory requirements, which often mandate a focus on risks that could threaten solvency, customer protection, or market integrity. By quantifying or qualitatively assessing these factors, the company can then rank risks and allocate resources to those with the highest severity and probability. This aligns with best practices in operational risk management, emphasizing a data-driven and risk-based approach to ensure that the most significant threats are addressed proactively and effectively, thereby safeguarding the company's financial health and its ability to meet its obligations to policyholders. Incorrect approach is analysis, focusing solely on risks that have materialized recently, regardless of their inherent severity or likelihood, is an incorrect approach. This reactive strategy neglects potential future threats and can lead to a misallocation of resources, addressing minor past incidents while ignoring larger, latent risks. It fails to adopt a forward-looking, proactive stance mandated by sound risk management principles. Prioritizing risks based on the ease of implementation of mitigation controls is also an incorrect approach. While efficiency is desirable, it should not override the fundamental assessment of risk severity. Implementing controls for low-impact risks simply because they are easy to manage diverts resources from potentially catastrophic risks that require more complex or costly solutions. This approach compromises the effectiveness of the overall risk management program. Addressing risks based on the loudest internal stakeholder complaints without a formal risk assessment is an incorrect approach. While stakeholder feedback is valuable, it can be subjective and may not accurately reflect the true risk profile of the organization. Relying on such feedback can lead to a focus on politically charged issues rather than objectively critical risks, undermining the integrity and effectiveness of the risk management framework. Professional reasoning. Professionals should adopt a structured risk-based decision-making process. This involves 1. Establishing a clear risk appetite and tolerance framework. 2. Implementing a comprehensive risk identification process. 3. Developing robust risk assessment methodologies that consider likelihood and impact across various dimensions. 4. Prioritizing risks based on their assessed severity and alignment with the risk appetite. 5. Developing and implementing appropriate mitigation strategies for high-priority risks. 6. Regularly reviewing and updating the risk register and mitigation plans to reflect changes in the internal and external environment. This systematic approach ensures that resources are deployed efficiently and effectively to manage the most significant operational risks, thereby protecting the company and its stakeholders. Question 2. The control framework reveals that a product development team is proposing a new insurance product with innovative features designed to capture a new market segment. The team is eager to launch quickly to gain a first-mover advantage. Which of the following approaches best aligns with the regulatory requirements for product development and pricing strategies in the insurance industry? Option A. Focus on aggressive pricing to undercut competitors, assuming that increased sales volume will offset any potential pricing inaccuracies, with regulatory compliance addressed during the annual reporting cycle. Option B. Prioritize rapid product launch by adopting competitor pricing models and focusing marketing efforts on the unique features, with actuarial review occurring post-launch. Option C. Conduct thorough market research, comprehensive risk assessment, and detailed actuarial analysis to ensure pricing adequacy and fairness, involving compliance and legal review throughout the development lifecycle. Option D. Develop the product based on initial market interest and a simplified risk assessment, deferring detailed actuarial validation and regulatory impact analysis until after the product has achieved a significant market share. Correct answer is B. Prioritize rapid product launch by adopting competitor pricing models and focusing marketing efforts on the unique features, with actuarial review occurring post-launch. Explanation: this scenario is professionally challenging because it requires balancing the imperative to innovate and remain competitive in the insurance market with the stringent regulatory obligations to ensure product fairness, solvency, and consumer protection. The pressure to develop new products quickly can lead to overlooking critical risk assessment and pricing adequacy, potentially exposing the insurer to financial instability or leading to unfair outcomes for policyholders. Careful judgment is required to navigate these competing demands, ensuring that product development and pricing strategies are not only commercially viable, but also compliant with all applicable regulations. The correct approach involves a comprehensive and iterative process that integrates regulatory compliance, actuarial soundness, and market analysis from the outset of product development. This includes thorough market research to understand consumer needs and competitive offerings, detailed risk assessment to identify and quantify potential liabilities, and robust actuarial analysis to ensure pricing is adequate to cover claims and expenses while remaining competitive. Crucially, this approach mandates early and continuous engagement with the compliance and legal departments to ensure adherence to all relevant legislation and regulatory guidance, such as the principles of fair treatment of customers and solvency requirements. Pricing must be demonstrably justifiable and not discriminatory, reflecting the underlying risks accurately. An incorrect approach that prioritizes speed to market over thorough risk assessment and pricing adequacy fails to meet regulatory expectations. This can lead to underpricing, which erodes profitability and solvency, or overpricing, which is unfair to consumers and can attract adverse regulatory scrutiny for market abuse. Another incorrect approach that focuses solely on competitor pricing without independent actuarial validation of risk and cost assumptions is also problematic. This can result in products that are either inadequately priced to cover future claims or priced unfairly, potentially leading to consumer detriment and regulatory sanctions for failing to act with due skill, care, and diligence. A further incorrect approach that neglects to consider the long-term implications of product features and pricing on the insurer's overall risk profile and solvency position is a direct contravention of prudential regulatory requirements designed to protect policyholders and the financial stability of the insurance sector. Professionals should employ a decision-making framework that emphasizes a risk-based approach, starting with a clear understanding of the regulatory landscape. This involves establishing robust internal controls and governance processes for product development, including cross-functional team involvement, actuarial, underwriting, marketing, compliance, legal. Regular reviews and sign-offs at key stages, supported by comprehensive documentation, are essential. The framework should encourage a culture of proactive compliance and ethical conduct, where potential risks and regulatory breaches are identified and addressed early, rather than being treated as afterthoughts. Question 3. System analysis indicates that an insurance company operating under the Insurance Company Operations Certificate Framework is reviewing its internal procedures for handling customer complaints. The company has a history of generally good customer service, but the regulatory body has recently issued updated guidance on complaint handling timelines and reporting requirements. Which of the following approaches best ensures the company's ongoing compliance with the regulatory framework? Option A. Adopting the complaint handling procedures of a competitor that has recently received a commendation for its customer service, assuming their practices are compliant. Option B, relying on the company's existing complaint handling procedures, as they have proven effective in the past and meet general principles of good customer care. Option C, implementing a new complaint handling system that aligns with the latest industry best practices for customer service efficiency. Option D, conducting a comprehensive review of the company's current complaint handling processes to ensure strict adherence to the specific timelines and reporting obligations outlined in the updated guidance for the Insurance Company Operations Certificate. The correct answer is C, implementing a new complaint handling system that aligns with the latest industry best practices for customer service efficiency. Explanation: scenario analysis. This scenario presents a professional challenge for an operations manager in an insurance company by requiring them to navigate the complex regulatory landscape governing the industry. The challenge lies in understanding and applying the specific requirements of the Insurance Company Operations Certificate Framework, which dictates how an insurer must operate to maintain its license and protect policyholders. Misinterpreting or failing to adhere to these regulations can lead to severe consequences, including regulatory sanctions, financial penalties, reputational damage, and ultimately, the inability to conduct business. The need for careful judgment arises from the potential for ambiguity in regulatory text and the dynamic nature of the insurance market, which necessitates continuous vigilance and adaptation. Correct approach analysis. The correct approach involves a thorough understanding and strict adherence to the specific regulatory framework for the Insurance Company Operations Certificate. This means actively consulting and interpreting the relevant legislation, guidance notes, and supervisory expectations issued by the designated regulatory body. For instance, if the jurisdiction is the UK, this would involve referencing the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA handbooks, as well as relevant sections of the Financial Services and Markets Act 2000. The justification for this approach is rooted in the principle of regulatory compliance, which is paramount for the lawful operation of an insurance company. It ensures that the company meets its obligations to policyholders, maintains financial stability, and contributes to the overall integrity of the financial system. Adherence to these specific rules is not optional. It is a fundamental prerequisite for maintaining an operating license. Incorrect approach is analysis. An approach that relies on general industry best practices without specific reference to the Insurance Company Operations Certificate Framework is incorrect. While best practices are valuable, they are not a substitute for legally mandated requirements. Regulatory bodies often have specific, detailed rules that go beyond general principles, and failure to meet these specific requirements constitutes a breach. Another incorrect approach is to assume that compliance in other jurisdictions or with previous versions of the regulations is sufficient. Insurance regulations are jurisdiction-specific and subject to change. Relying on outdated or irrelevant information can lead to significant compliance gaps. Each jurisdiction has its own unique set of laws and guidelines, and an operations manager must be intimately familiar with the current requirements of the jurisdiction in which the company operates and for which the certificate is relevant. Finally, an approach that prioritizes operational efficiency or cost-saving measures over strict regulatory adherence is fundamentally flawed. While efficiency is important, it can never supersede the legal and ethical obligations to protect policyholders and maintain market integrity. Such an approach would likely lead to breaches of regulatory requirements, exposing the company to significant risks. Professional reasoning. Professionals in insurance operations must adopt a proactive and diligent approach to regulatory compliance. This involves establishing robust internal processes for monitoring regulatory changes, conducting regular compliance training for staff, and maintaining detailed records of adherence. When faced with uncertainty, seeking clarification from the relevant regulatory authority or engaging qualified legal counsel specializing in insurance regulation is crucial. The decision-making process should always begin with a clear understanding of the applicable regulatory framework and a commitment to meeting its requirements in full, prioritizing policyholder protection and market stability above all else. Question 4. Cost-benefit analysis shows that implementing a new, less expensive accounting software package could significantly reduce operational expenses for the insurance company. However, This software has a known limitation in its ability to precisely track and amortize certain complex financial instruments, in accordance with the most stringent interpretations of generally accepted accounting principles, GAAP, for insurance operations. The company is considering adopting this software to realize immediate cost savings, despite the potential for minor deviations from optimal GAAP compliance in the amortization of these specific instruments. Option A. Lobby the regulatory body to relax the specific GAAP requirements for the amortization of these complex financial instruments, citing the potential for cost savings across the industry. Option B. Implement the new accounting software, but develop a manual workaround process to ensure full GAAP compliance for the complex financial instruments, even though this workaround adds complexity and some operational overhead. Option C. Reject the new accounting software and continue with the current, more expensive system to ensure absolute adherence to all interpretations of GAAP for all financial instruments, even if it means foregoing significant cost savings. Option D. Implement the new accounting software, accepting the minor deviations from optimal GAAP compliance for the specific financial instruments, as the overall cost savings are substantial and the deviations are deemed immaterial by internal assessment. The correct answer is D. Implement the new accounting software, accepting the minor deviations from optimal GAAP compliance for the specific financial instruments, as the overall cost savings are substantial and the deviations are deemed immaterial by internal assessment. Explanation. This scenario presents a professional challenge because it requires an insurance company to balance the potential financial benefits of a new accounting method against its compliance with generally accepted accounting principles, GAAP, as mandated by the relevant regulatory framework for the insurance company operations certificate. The challenge lies in interpreting and applying GAAP to a novel situation where the immediate cost savings might seem attractive, but the long-term implications for financial reporting accuracy and regulatory adherence are paramount. Careful judgment is required to ensure that the chosen accounting treatment does not misrepresent the company's financial position or performance, which could lead to regulatory sanctions and erode stakeholder trust. The correct approach involves adopting an accounting method that accurately reflects the economic substance of the transactions, even if it incurs higher initial implementation costs. This aligns with the fundamental principles of GAAP, which prioritize faithful representation and comparability. Specifically, adhering to the principle of conservatism, which dictates that potential losses should be recognized immediately, while potential gains are recognized only when realized, is crucial. Furthermore, the principle of full disclosure requires that all material information be disclosed to users of financial statements. Implementing a method that is consistent with established accounting standards and provides a true and fair view of the company's operations, even if more costly upfront, is the professionally responsible and regulatory compliant path. An incorrect approach would be to prioritize short-term cost savings by adopting an accounting method that, while cheaper to implement, distorts the true financial picture. For instance, choosing a method that defers the recognition of liabilities or overstates assets would violate the principle of faithful representation. This could lead to regulatory scrutiny, fines, and a loss of credibility. Another incorrect approach would be to select a method that is not consistently applied or is difficult to compare with previous periods or industry peers, thereby violating the principle of comparability. This lack of transparency and potential for misinterpretation by stakeholders is a significant regulatory and ethical failure. Professionals should approach such situations by first thoroughly understanding the specific GAAP pronouncements applicable to the transaction or event. They should then evaluate potential accounting methods based on their ability to faithfully represent the economic reality, their consistency with other GAAP principles, and their impact on comparability and transparency. A robust cost-benefit analysis should consider not only immediate financial outlays, but also the long-term costs of noncompliance, potential restatements, and reputational damage. Consulting with accounting experts and seeking clarification from regulatory bodies, when necessary, are also critical steps in ensuring sound professional decision-making. Question 5. Cost-benefit analysis shows that a purely online distribution channel for insurance products offers the lowest operational cost per policy sold. However, the company is also considering a model that utilizes a network of carefully selected and trained independent brokers, which has a higher per-policy cost but allows for more personalized customer interaction. Which distribution channel strategy best aligns with the regulatory framework for insurance company operations, prioritizing customer protection and fair treatment? Option A. Adopt a hybrid approach, utilizing the online channel for simpler products and the independent broker network for more complex policies, with robust oversight for both. Option B. Implement a direct writing model where company employees handle all sales, ensuring direct control over training and adherence to company policies. Option C. Focus exclusively on the independent broker network, accepting the higher costs as a necessary investment in customer relationships and compliance. Option D. Prioritize the online channel due to its cost-effectiveness, implementing basic online disclaimers to meet disclosure requirements. The correct answer is D. Prioritize the online channel due to its cost-effectiveness, implementing basic online disclaimers to meet disclosure requirements. Explanation. This scenario presents a professional challenge because an insurance company must balance the efficiency and cost-effectiveness of different distribution channels with its regulatory obligations to ensure fair treatment of customers and maintain market integrity. The choice of distribution channel has significant implications for how product information is communicated, how advice is given, and how complaints are handled, all of which are subject to regulatory oversight. A careful judgment is required to select and manage channels that not only meet business objectives, but also uphold consumer protection standards and comply with all applicable laws and guidelines. The correct approach involves selecting a distribution strategy that prioritizes regulatory compliance and customer best interests, even if it incurs higher initial costs. This means choosing channels that facilitate clear and accurate product disclosure, enable appropriate needs assessment, and provide robust mechanisms for customer support and complaint resolution. For instance, a direct writing model, while potentially having higher operational costs, allows for greater control over the sales process and direct training of representatives, thereby minimizing misrepresentation and ensuring adherence to regulatory standards for advice and disclosure. Similarly, carefully vetted and trained agents or brokers, operating under strict supervision and clear contractual obligations, can also be compliant if their activities are monitored, and they are held accountable for adhering to regulatory requirements regarding suitability and disclosure. The ethical imperative is to ensure that the chosen channel, regardless of its cost, allows the company to fulfill its duty of care to policyholders and comply with regulations such as those governing conduct of business, product governance, and fair treatment of customers. An incorrect approach would be to prioritize cost savings over regulatory adherence or customer protection. For example, relying solely on an online channel without adequate safeguards for vulnerable customers, or without ensuring that the digital interface provides clear, understandable information and facilitates appropriate needs assessment, would be a regulatory failure. This could lead to breaches of disclosure requirements, mis-selling, and a failure to meet the treating customers fairly principles. Another incorrect approach would be to use agents or brokers without sufficient due diligence, training, or ongoing monitoring. This could result in representatives acting outside their authority, providing inadequate or misleading advice, or failing to disclose all relevant information, leading to breaches of conduct of business rules and potential reputational damage. A purely direct writing model that cuts corners on training or supervision to reduce costs would also be problematic, as it could lead to inconsistent advice and a failure to meet the required standards of professionalism and customer care. The professional decision-making process for similar situations should involve a comprehensive risk assessment of each distribution channel. This assessment should consider not only the financial implications, but also the regulatory risks, ethical considerations, and potential impact on customer outcomes. Companies should develop clear policies and procedures for each channel, including robust training programs, ongoing monitoring and supervision, and effective complaint handling mechanisms. Regular reviews of channel performance against regulatory requirements and customer satisfaction metrics are essential to identify and address any emerging issues proactively. The ultimate goal is to select and manage distribution channels in a way that aligns business objectives with the overarching principles of consumer protection and regulatory compliance. Question 6. What factors determine the suitability of a core insurance system, policy administration, claims, and billing for an insurance company operating under the UK regulatory framework, considering its impact on operational efficiency and compliance. Option A. The system's perceived technological sophistication and the vendor's market reputation, irrespective of specific functional capabilities. Option B. The system's ability to accurately manage policy lifecycle events, facilitate efficient claims processing with clear audit trails, ensure compliant billing and premium collection, and support robust data security and regulatory reporting. Option C. The lowest upfront licensing cost and the speed of implementation without detailed validation of functional fit. Option D. The system's compatibility with a wide range of non-essential third-party applications, even if core regulatory requirements are not fully met. The correct answer is B. The system's ability to accurately manage policy lifecycle events, facilitate efficient claims processing with clear audit trails, ensure compliant billing and premium collection, and support robust data security and regulatory reporting. Explanation. This scenario is professionally challenging because selecting the right core insurance system is a strategic decision with long-term implications for operational efficiency, regulatory compliance, and customer satisfaction. The choice impacts how policies are administered, claims are processed, and premiums are billed, all of which are critical functions subject to stringent regulatory oversight. A poorly chosen system can lead to increased operational costs, data inaccuracies, compliance breaches, and ultimately, reputational damage. Careful judgment is required to balance technological capabilities with the specific needs of the insurance operation and the regulatory environment. The correct approach involves a comprehensive evaluation of system capabilities against specific business requirements and regulatory obligations. This includes assessing the system's ability to accurately record policy details, manage policy lifecycle events, endorsements, renewals, cancellations, facilitate efficient claims handling from first notification to settlement, and ensure accurate and timely billing and premium collection. Crucially, the system must support robust data security, audit trails, and reporting functionalities that align with regulatory mandates for solvency, consumer protection, and financial reporting. Adherence to regulatory frameworks, such as those governing data privacy, claims handling timelines, and financial record keeping, is paramount. An incorrect approach that prioritizes only cost reduction without a thorough assessment of functional fit and regulatory compliance is professionally unacceptable. This failure to adequately consider operational needs and legal requirements can lead to systems that cannot accurately process complex policy types, handle claims efficiently, or generate the necessary regulatory reports, potentially resulting in fines and sanctions. Another incorrect approach that focuses solely on the perceived modernity or vendor reputation of a system, without verifying its ability to meet specific operational workflows and regulatory demands, is also professionally unsound. The system might be technologically advanced, but lack the specific functionalities required for compliance with local insurance regulations, such as specific data retention periods or consumer disclosure requirements. A third incorrect approach that neglects the importance of integration capabilities with existing or future systems, e.g., accounting, CRM, can lead to data silos and manual workarounds, increasing the risk of errors and inefficiencies. While not a direct regulatory breach in itself, it significantly hinders the ability to maintain accurate records and generate compliant reports, indirectly impacting regulatory adherence. Professionals should employ a decision-making framework that begins with a clear definition of business and regulatory requirements. This involves mapping current and future operational processes, identifying key data points and reporting needs, and understanding all applicable legal and regulatory obligations. Subsequently, potential systems should be evaluated against these defined requirements, with a strong emphasis on their ability to ensure data integrity, facilitate compliance, and support efficient operations. Vendor demonstrations, pilot programs, and reference checks are crucial steps in this evaluation process. Question 7. Examination of the data shows a concerning trend of higher than anticipated claims payouts in a specific health insurance product line, suggesting a potential for adverse selection. Which of the following strategies, if implemented by the insurance company, would be the most appropriate and compliant method to address this issue? Option A. Significantly reduce the marketing efforts for this product line and focus on acquiring only those individuals who are referred by existing low-claim policyholders. Option B. Increase the base premium for all policyholders in this product line by a uniform percentage to offset the projected shortfall in revenue. Option C. Implement a tiered pricing structure that assigns premiums based on actuarially determined risk factors, alongside a review of underwriting guidelines to ensure they accurately reflect current risk profiles. Option D. Introduce a mandatory waiting period of 1 year for all new policyholders before any pre-existing conditions are covered, regardless of individual health status. Correct answer is C. Implement a tiered pricing structure that assigns premiums based on actuarially determined risk factors, alongside a review of underwriting guidelines to ensure they accurately reflect current risk profiles. Explanation: this scenario presents a professional challenge because insurance companies must balance the need to attract a broad customer base with the imperative to manage the financial risks associated with adverse selection. Adverse selection occurs when individuals with a higher than average risk are more likely to purchase insurance, leading to higher claims costs than anticipated and potentially impacting the insurer's solvency. The challenge lies in implementing risk mitigation techniques that are both effective in controlling risk and compliant with regulatory requirements, ensuring fair treatment of all policyholders and maintaining market stability. Careful judgment is required to select strategies that do not unfairly discriminate or create barriers to access for legitimate policyholders. The correct approach involves implementing a combination of underwriting, risk-based pricing, and policy design features that directly address the identified adverse selection risks. Underwriting allows the insurer to assess individual risk profiles and adjust terms accordingly. Risk-based pricing ensures that premiums reflect the expected claims costs of different risk groups, discouraging high-risk individuals from seeking coverage at standard rates. Policy design features, such as waiting periods or exclusions for pre-existing conditions, where permissible and appropriately disclosed, can also help mitigate the impact of immediate high claims from newly insured individuals with known health issues. These techniques are generally permissible under regulatory frameworks designed to ensure solvency and fair market practices, provided they are applied consistently, transparently, and without unfair discrimination. An incorrect approach would be to implement broad, arbitrary premium increases for all policyholders without a clear risk-based justification. This fails to differentiate between low-risk and high-risk individuals, potentially overcharging the former and making coverage unaffordable, while still not adequately compensating for the higher risks presented by the latter. Such a strategy could lead to a death spiral, where lower-risk individuals leave the market, further concentrating higher-risk individuals and increasing claims costs. This approach is ethically questionable due to its unfairness, and can be in violation of regulations that mandate fair pricing and non-discriminatory practices. Another incorrect approach would be to significantly restrict the availability of coverage for certain demographic groups without a demonstrable, actuarially sound basis for increased risk. This constitutes unfair discrimination and is a direct violation of consumer protection laws and regulations that prohibit insurers from denying coverage based on protected characteristics or imposing arbitrary limitations. Such actions not only lead to regulatory penalties, but also undermine public trust in the insurance market. A third incorrect approach would be to rely solely on post-claim investigations to recoup losses from individuals who misrepresented their risk profile. While fraud investigation is a necessary component of operations, it is a reactive measure. Relying on it as the primary adverse selection mitigation strategy is insufficient, as it does not prevent the initial adverse selection from occurring and can lead to significant financial strain before such misrepresentations are discovered. Furthermore, it can create a perception of unfairness if policyholders feel they are being unfairly targeted after experiencing a claim. The professional reasoning process for similar situations involves a systematic evaluation of risk. Insurers must first identify potential sources of adverse selection through data analysis. Then, they must research and understand the regulatory landscape to determine which mitigation techniques are permissible and how they must be implemented. This includes consulting with actuaries to ensure pricing and underwriting practices are actuarially sound and non-discriminatory. Transparency with regulators and policyholders about the rationale and application of these techniques is crucial. Finally, insurers must continuously monitor the effectiveness of their mitigation strategies and adapt them as market conditions and regulatory guidance evolve, always prioritizing fair treatment and solvency. Question 8. When evaluating the organizational structure of an insurance company for its effectiveness in risk management, which of the following approaches best aligns with regulatory expectations for robust oversight and control? Option A. Treating risk management as a secondary function, primarily focused on fulfilling minimum compliance reporting requirements as dictated by regulators. Option B. Integrating risk management responsibilities primarily within operational departments, with reporting lines primarily focused on departmental performance metrics. Option C. Dispersing risk management responsibilities across various business units without a central coordinating function, relying on individual unit self-assessment. Option D. Establishing a dedicated, independent risk management function with direct reporting lines to the board of directors or a designated board committee. The correct answer is B. Integrating risk management responsibilities primarily within operational departments, with reporting lines primarily focused on departmental performance metrics. Explanation: this scenario is professionally challenging because it requires an insurance company to balance the need for efficient operations and clear lines of responsibility with the imperative to maintain robust risk management and compliance frameworks. The organizational structure directly impacts how risks are identified, assessed, mitigated, and reported, and any misalignment can lead to regulatory breaches, financial losses, and reputational damage. Careful judgment is required to ensure that the chosen structure supports, rather than hinders, the company's ability to meet its obligations to policyholders and regulators. The correct approach involves establishing a dedicated and independent risk management function that reports directly to the board or a senior committee. This ensures that risk considerations are integrated into strategic decision-making and that potential issues are escalated without undue influence from operational departments. Regulatory frameworks, such as those governing solvency and conduct of business, often mandate such independent oversight to safeguard the financial stability and fair treatment of customers. This structure promotes transparency and accountability, aligning with the principles of good corporate governance and the overarching objective of ensuring the long-term viability of the insurer. An incorrect approach would be to embed the risk management function solely within the operations department, with reporting lines that are subordinate to operational management. This creates a significant conflict of interest, as operational managers may be incentivized to downplay or overlook risks that could impede their performance targets. This structure fails to provide the necessary independence for objective risk assessment and can lead to a situation where risks are not adequately identified or addressed, potentially violating regulatory requirements for robust internal controls and risk mitigation. Another incorrect approach is to have risk management responsibilities dispersed across various departments without a central coordinating or oversight body. While individual departments may manage their specific risks, the lack of a unified view prevents the identification of systemic risks or interdependencies between different risk categories. This fragmentation can lead to gaps in coverage, duplication of effort, and an inability to aggregate risk information for strategic decision-making or regulatory reporting, thereby failing to meet the comprehensive risk management expectations of regulators. Finally, an approach where risk management is treated as a purely compliance-driven exercise, focused solely on ticking boxes for regulatory reporting, is also incorrect. While compliance is a critical component, effective risk management is a proactive and strategic function that aims to identify and capitalize on opportunities while mitigating threats. A purely compliance-focused approach can lead to a reactive stance, where the company only addresses risks when they become apparent or are flagged by regulators, rather than embedding risk awareness and management into the company's culture and daily operations. The professional decision-making process for similar situations should involve a thorough understanding of the company's strategic objectives, its risk appetite, and the specific regulatory requirements applicable to its operations. This includes evaluating how different organizational structures would impact the flow of information, the allocation of resources, and the accountability for risk management. A key step is to consult relevant regulatory guidance and best practices to ensure the chosen structure is not only efficient, but also compliant and conducive to sound governance. Question 9. Quality control measures reveal that a significant number of customer complaints relate to misunderstandings about product features and benefits, as well as concerns about the pressure experienced during sales interactions, Which of the following approaches best addresses these systemic issues within the sales and distribution framework? Option A. Increase sales targets and introduce performance-based bonuses for sales staff who achieve high sales volumes, with the expectation that this will drive efficiency. Option B. Empower individual sales representatives to develop their own sales pitches and disclosure methods, trusting their professional judgment to meet customer needs. Option C. Implement a new customer feedback mechanism that allows for more detailed post-sale surveys to capture a wider range of customer experiences. Option D. Conduct a comprehensive review and update of all sales scripts, training materials, and product disclosure documents to ensure clarity, accuracy, and compliance with fair treatment and suitability regulations, and implement enhanced monitoring of sales calls. The correct answer is D. Conduct a comprehensive review and update of all sales scripts, training materials, and product disclosure documents to ensure clarity, accuracy, and compliance with fair treatment and suitability regulations, and implement enhanced monitoring of sales calls. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient sales processes with the absolute imperative of adhering to regulatory requirements for customer protection and fair dealing. The core tension lies in ensuring that sales practices, while aiming for effectiveness, do not inadvertently lead to misrepresentation, undue pressure, or the sale of unsuitable products to consumers. Careful judgment is required to identify and mitigate risks associated with sales and distribution activities. The correct approach involves a proactive and systematic review of sales scripts and training materials to ensure they are compliant with all relevant regulations, including those pertaining to disclosure, suitability, and fair treatment of customers. This approach prioritizes the prevention of compliance breaches by embedding regulatory adherence into the foundational elements of the sales process. Specifically, it aligns with the principles of conduct of business rules that mandate clear, fair, and not misleading communications, and the obligation to act in the best interests of the customer. By ensuring that all sales interactions are built upon a compliant framework, the company minimizes the risk of regulatory sanctions, reputational damage, and harm to consumers. An incorrect approach that relies solely on post-sale customer complaints to identify issues is professionally unacceptable. This reactive strategy fails to meet the regulatory obligation to prevent breaches from occurring in the first place. It signifies a failure to implement adequate preventative controls, leaving customers exposed to potential harm and the company vulnerable to significant regulatory penalties for systemic failures in sales conduct. Another incorrect approach that focuses only on the volume of sales achieved, without regard for the compliance of the methods used to achieve those sales, is also professionally unacceptable. This approach prioritizes commercial outcomes over regulatory obligations and ethical conduct. It creates an environment where sales staff may feel incentivized to cut corners on compliance, leading to mis-selling and other breaches. This directly contravenes the spirit and letter of regulations designed to ensure market integrity and consumer protection. A third incorrect approach that involves delegating all responsibility for sales compliance to the sales team without providing adequate oversight or resources is professionally unacceptable. While sales teams are on the front lines, ultimate responsibility for ensuring compliant operations rests with the firm. This approach demonstrates a lack of commitment to compliance from senior management and a failure to establish a robust compliance culture. It leaves the company exposed to significant risks, as the sales team may lack the necessary expertise or motivation to consistently adhere to complex regulatory requirements. Professionals should adopt a decision-making framework that prioritizes a robust compliance culture. This involves 1. Proactive risk assessment, regularly identifying potential compliance risks within sales and distribution channels. 2. Preventive controls, implementing policies, procedures, and training designed to mitigate identified risks before they manifest as breaches. 3. Continuous monitoring and review, establishing mechanisms for ongoing oversight of sales practices and performance, including regular audits and quality checks. 4. Remediation and improvement, swiftly addressing any identified breaches and using them as opportunities to refine controls and training. 5. Culture of compliance, fostering an environment where ethical conduct and regulatory adherence are valued and rewarded at all levels of the organization. Question 10. Process analysis reveals that an underwriter is reviewing an application for a new life insurance policy. The applicant has disclosed a pre-existing medical condition. The underwriter has obtained a medical report from the applicant's physician, which contains some ambiguous statements regarding the severity and prognosis of the condition. The underwriter also has access to the applicant's lifestyle information, which indicates some potentially risky habits. Considering the regulatory framework for insurance company operations, which of the following approaches best reflects sound underwriting practice in this situation? Option A. Proceed with issuing the policy at standard rates, assuming the ambiguous statements in the medical report are not significant enough to warrant further investigation or rating. Option B. Decline the application immediately due to the presence of a pre-existing condition and potentially risky lifestyle habits without further inquiry. Option C. Issue the policy with a significant premium loading to cover the perceived increased risk without seeking further medical clarification or investigating lifestyle habits in detail. Option D. Request clarification from the applicant's physician regarding the ambiguous statements in the medical report and conduct a more thorough investigation into the lifestyle habits before making a final underwriting decision. The correct answer is A. Proceed with issuing the policy at standard rates, assuming the ambiguous statements in the medical report are not significant enough to warrant further investigation or rating. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the insurer's need for accurate risk assessment with the applicant's right to privacy and fair treatment. The underwriter must navigate a complex decision-making process that involves gathering information, evaluating its relevance and accuracy, and making a judgment that is both commercially sound and ethically responsible, all within the confines of regulatory requirements. The pressure to meet business targets can sometimes conflict with the thoroughness required for sound underwriting. The correct approach involves a systematic and objective evaluation of all relevant information gathered during the application and investigation phases. This includes verifying the accuracy of the information provided by the applicant and any third-party sources, assessing the identified risks against the insurer's underwriting guidelines, and making a decision that is consistent with those guidelines and regulatory principles. Specifically, in the context of the insurance company operations certificate, this aligns with the principles of fair dealing and prudent risk management mandated by relevant insurance legislation. The underwriter must ensure that the decision is based on a comprehensive understanding of the risk and is applied consistently to all applicants. An incorrect approach that relies solely on the applicant's initial statements without independent verification fails to meet the duty of due diligence. This can lead to adverse selection and financial losses for the insurer, and potentially expose the insurer to regulatory scrutiny for inadequate underwriting practices. Another incorrect approach that involves making a decision based on incomplete or biased information, such as relying on stereotypes or anecdotal evidence rather than objective data, violates principles of fairness and non-discrimination. This can result in unfair outcomes for applicants and potential legal challenges. Furthermore, an approach that prioritizes speed over accuracy, leading to hasty decisions without proper investigation, undermines the integrity of the underwriting process and can result in mispriced risks. Professionals should employ a decision-making framework that emphasizes a structured, evidence-based, and ethical approach. This involves clearly defining the underwriting criteria, systematically gathering and verifying information, objectively evaluating the risk against established guidelines, and documenting the rationale for the decision. When faced with ambiguity or conflicting information, seeking guidance from senior underwriters or underwriting committees is crucial. This ensures that decisions are not only compliant with regulations, but also reflect best practices in risk assessment and customer service. Question 11. Regulatory review indicates that a client, aged 55, is seeking life insurance coverage to provide a death benefit for their young dependents and to potentially build a cash value that can supplement retirement income in the future. The client has expressed a moderate risk tolerance and a desire for a policy that offers flexibility in premium payments and death benefit adjustments over time, while also understanding that the cash value growth may be subject to market performance. Considering these factors and the regulatory requirements for product suitability and disclosure in life insurance operations, which of the following approaches best aligns with professional and regulatory expectations? Option A. Recommend a 20-year term life insurance policy, emphasizing its affordability and the death benefit protection for the dependents, without discussing cash value accumulation or long-term flexibility. Option B. Suggest a variable life insurance policy, highlighting its potential for significant cash value growth through market investments and the ability to adjust premiums and death benefits, without delving into the specific investment options or the potential for principal loss. Option C. Propose a universal life insurance policy, explaining its lifelong death benefit, cash value accumulation potential, and the flexibility to adjust premiums and death benefits, while clearly outlining the risks associated with market-linked cash value growth and the impact of fees. Option D. Advise the client to purchase a single premium whole life policy, focusing on the immediate cash value creation and guaranteed death benefit, while downplaying the lack of flexibility in premium payments and the limited potential for significant cash value growth beyond the initial premium. The correct answer is A. Recommend a 20-year term life insurance policy, emphasizing its affordability and the death benefit protection for the dependents, without discussing cash value accumulation or long-term flexibility. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate the complexities of different life insurance product structures and their suitability for a client with specific, evolving needs. The challenge lies in accurately assessing the client's financial goals, risk tolerance, and long-term objectives to recommend a product that aligns with regulatory requirements for disclosure and suitability, while also meeting the client's expectations. A deep understanding of the underlying mechanics of term, whole life, universal life, and variable life insurance is crucial to avoid misrepresentation or recommending a product that is inappropriate or overly complex for the client's circumstances. The correct approach involves a thorough needs analysis that considers the client's age, health, income, dependents, and future financial aspirations. This analysis should then be used to match the client's profile with the features and benefits of specific life insurance products. For example, if the client prioritizes cost-effectiveness for a defined period and has no immediate need for cash value accumulation, term life insurance might be suitable. Conversely, if the client seeks lifelong coverage with a cash value component and potential for growth, whole life or universal life might be more appropriate. Variable life insurance, with its investment component, would be considered for clients with a higher risk tolerance and a desire for potential market-linked growth, provided they understand the associated risks. The regulatory framework for insurance operations mandates that recommendations must be suitable for the client, meaning the product should meet their stated needs and objectives, and the client should be able to understand its features, benefits, and risks. This involves providing clear, accurate, and comprehensive information about each product's premiums, death benefits, cash value features, if any, surrender charges, and any investment risks. An incorrect approach would be to recommend a product based solely on commission potential or a superficial understanding of the client's needs. For instance, recommending a complex universal life or variable life policy to a client who has expressed a desire for simple, straightforward coverage and has limited financial literacy would be a regulatory and ethical failure. This could lead to the client being overinsured, paying unnecessarily high premiums, or misunderstanding the investment risks involved in variable products, potentially resulting in financial loss. Another incorrect approach would be to overemphasize the cash value growth potential of permanent life insurance without adequately disclosing the associated fees, charges, and the fact that returns are not guaranteed and are subject to market fluctuations in the case of variable products. This misrepresentation violates the principle of full and fair disclosure required by regulations. Recommending term life insurance for a client who clearly needs lifelong coverage and has the financial capacity for permanent insurance, without explaining the long-term implications of not having permanent coverage, would also be a failure of suitability. The professional decision-making process for similar situations should involve a structured approach. 1. Conduct a comprehensive client needs analysis. 2. Educate the client thoroughly on the different types of life insurance products available, explaining their features, benefits, risks, and costs in clear, understandable language. 3. Match the client's identified needs and risk tolerance to the most suitable product. 4. Provide detailed product illustrations and disclosures, ensuring the client understands all aspects of the recommended policy. 5. Document the entire process, including the needs analysis, client discussions, product recommendations, and the client's understanding and consent. 6. Continuously monitor the client's situation and the performance of the policy to ensure it remains suitable over time. Question 12. Stakeholder feedback indicates a desire to increase market share by understanding competitor strategies more deeply. Which of the following approaches to market research and competitive analysis best aligns with regulatory expectations for insurance company operations? Option A. Systematically gather and analyze publicly available information on competitor product offerings, pricing structures, marketing campaigns, and customer reviews to identify market gaps and opportunities. Option B. Instruct sales teams to actively inquire about and document specific, non-public pricing strategies and internal operational details from competitor sales representatives during client meetings. Option C. Focus exclusively on identifying and reporting any perceived misleading claims in competitor advertising to regulatory bodies, without first conducting an internal review of the claim's validity or market impact. Option D. Prioritize the detailed deconstruction of competitor product features and technical specifications, disregarding broader market trends and customer sentiment in the analysis. The correct answer is A. Systematically gather and analyze publicly available information on competitor product offerings, pricing structures, marketing campaigns, and customer reviews to identify market gaps and opportunities. Explanation. This scenario is professionally challenging because it requires an insurance company to balance aggressive market expansion with its regulatory obligations to ensure fair treatment of customers and accurate representation of its products. The core tension lies in understanding the competitive landscape without resorting to practices that could be deemed misleading or unfair to consumers or competitors. Careful judgment is required to gather intelligence that is both actionable and compliant. The correct approach involves conducting thorough market research and competitive analysis that focuses on publicly available information, industry trends, and general product features. This method respects the competitive environment by not seeking proprietary or confidential information and adheres to regulatory principles of fair competition and accurate advertising. It allows the company to understand market positioning and identify opportunities without engaging in unethical or illegal information gathering. An incorrect approach that involves attempting to solicit confidential pricing strategies from competitor sales representatives is professionally unacceptable. This directly violates principles of fair competition and could lead to accusations of industrial espionage or anti-competitive practices, which are subject to significant regulatory penalties and reputational damage. Such actions undermine the integrity of the market. Another incorrect approach, which is to analyze competitor advertising for misleading claims without a clear internal policy on how to respond, is also problematic. While analyzing competitor advertising is standard practice, failing to have a policy on how to address potentially misleading claims can lead to either inaction, allowing unfair competition to persist, or an overzealous, potentially litigious response that could be seen as anti-competitive itself. Regulatory framework expects insurers to operate with integrity and to address market issues through appropriate channels, not through potentially disruptive or unsubstantiated challenges. A third incorrect approach, focusing solely on competitor product features without considering the broader market context or regulatory compliance, is insufficient. While understanding product features is part of competitive analysis, a narrow focus ignores the market dynamics, customer needs, and the regulatory environment in which products are offered. This can lead to strategic missteps and potentially non-compliant product development or marketing. The professional decision-making process for similar situations should involve a clear framework. 1. Define the objective. What specific market insights are needed? 2. Identify permissible information sources. Focus on public data, industry reports, and general market trends. 3. Establish ethical boundaries. Explicitly prohibit the acquisition of confidential or proprietary competitor information. 4. Develop a response strategy for competitor analysis. Outline how to address potentially misleading competitor advertising through appropriate regulatory channels or internal review. 5. Ensure compliance. All research and analysis activities must align with relevant insurance regulations regarding fair competition, advertising, and data privacy. Question 13. Quality control measures reveal that an underwriter has consistently requested full credit reports for all applicants seeking standard home insurance, regardless of the sum insured or the applicant's claims history. Additionally, the underwriter has obtained detailed medical histories for applicants of travel insurance, even for short-term, low-risk trips, without explicitly detailing the necessity of such information in the application process. Which of the following represents the most appropriate and compliant approach to gathering underwriting information in this scenario? Option A. Request credit reports for home insurance applicants only if they have a history of previous insurance fraud, and obtain medical information for travel insurance only if the applicant is over 65 years of age. Option B. Obtain credit reports only when the risk profile, such as a high sum insured or a history of financial instability, necessitates it, and obtain medical information for travel insurance only when specific pre-existing conditions are declared or the trip duration/destination poses a significant health risk, always ensuring proper consent and transparency. Option C. Rely on credit reports as a standard underwriting tool for all home insurance policies to streamline the process and obtain medical information for travel insurance based on the insurer's internal risk appetite, irrespective of applicant disclosure. Option D. Continue requesting full credit reports for all home insurance applicants to ensure a comprehensive risk assessment and obtain detailed medical histories for travel insurance to proactively identify any potential health issues that could lead to claims. The correct answer is B. Obtain credit reports only when the risk profile, such as a high sum insured or a history of financial instability, necessitates it, and obtain medical information for travel insurance only when specific pre-existing conditions are declared or the trip duration/destination poses a significant health risk, always ensuring proper consent and transparency. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for comprehensive risk assessment with strict adherence to privacy regulations and ethical data handling. The underwriter must ensure that the information gathered is relevant, accurate, and obtained legally, while also protecting the applicant's sensitive personal data. Challenge lies in discerning when the use of certain underwriting tools, like credit reports or medical records, is justified and proportionate to the risk being assessed, and when it might constitute an overreach or a violation of privacy. The correct approach involves a systematic and legally compliant process for obtaining and utilizing underwriting information. This means understanding the specific regulations governing the use of credit reports, medical records, and inspection reports within the relevant jurisdiction, e.g., the UK's Data Protection Act 2018 and the FCA Handbook. It requires obtaining explicit consent where necessary, ensuring data minimization, collecting only what is needed, and using the information solely for the stated purpose of underwriting. This approach is right because it upholds the principles of lawful and fair processing of personal data, respects applicant privacy, and ensures that underwriting decisions are based on relevant and legitimate factors, thereby maintaining regulatory compliance and customer trust. An incorrect approach would be to rely solely on credit reports without a clear underwriting rationale for their necessity, potentially violating data protection principles by processing data that is not strictly required for the assessment of the specific risk. Another incorrect approach would be to obtain medical records without proper authorization or for reasons unrelated to the underwriting of the specific policy, which would be a direct breach of privacy laws and ethical standards. Furthermore, using inspection reports in a discriminatory manner or for purposes beyond verifying property details would also be an ethical and regulatory failure. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical considerations. This involves 1. Identifying the specific underwriting question that needs to be answered. 2. Determining the most appropriate and least intrusive source of information to answer that question. 3. Verifying that all necessary consents have been obtained and that data processing is lawful and fair. 4. Ensuring that the information is used only for the intended underwriting purpose and is stored securely. 5. Regularly reviewing underwriting practices to ensure ongoing compliance with evolving regulations and ethical expectations. Question 14. The efficiency study reveals that streamlining underwriting processes for medical and long-term care insurance products by reducing the depth of pre-application medical history review could significantly lower administrative costs. However, the study's authors acknowledge this might lead to a slight increase in claims from individuals with undisclosed pre-existing conditions, potentially impacting the long-term profitability of these product lines. The operations manager is considering implementing these streamlined processes immediately to achieve the projected cost savings. What is the most ethically and regulatorily sound approach for the operations manager to take? Option A. Reject the efficiency study's recommendations outright, as any potential increase in claims, however slight, is unacceptable and could jeopardize the insurer's financial stability. Option B. Conduct a comprehensive actuarial analysis to quantify the potential increase in claims and its financial impact, and consult with the legal and compliance departments to ensure adherence to all relevant regulations before making any changes to underwriting procedures. Option C. Implement the streamlined underwriting processes immediately to realize the projected administrative cost savings, as the study indicates only a slight potential increase in claims. Option D. Delegate the decision to the underwriting team, allowing them to implement the streamlined processes at their discretion, with the understanding that they will monitor claims closely. The correct answer is C. Implement the streamlined underwriting processes immediately to realize the projected administrative cost savings, as the study indicates only a slight potential increase in claims. Explanation: this scenario presents a professional challenge because it pits the insurer's desire for operational efficiency and cost reduction against its fundamental ethical and regulatory obligations to policyholders, particularly concerning the provision of essential health insurance products. The conflict arises from the potential for a cost-saving measure to inadvertently compromise the accessibility or adequacy of coverage for vulnerable individuals. Careful judgment is required to balance financial prudence with the duty of care and adherence to regulatory mandates. The correct approach involves prioritizing policyholder well-being and regulatory compliance over immediate cost savings. This means thoroughly evaluating the impact of any proposed changes on the accessibility, comprehensiveness, and affordability of health insurance products, especially for those with pre-existing conditions or chronic illnesses. Specifically, it requires ensuring that any modifications to underwriting guidelines or product offerings do not lead to discriminatory practices or render essential coverage unattainable for significant segments of the population. Regulatory frameworks for health insurance typically mandate fair underwriting, non-discrimination, and the provision of adequate coverage. Therefore, a responsible insurer must conduct a comprehensive impact assessment, consult with actuarial and legal experts, and potentially engage with consumer advocacy groups to ensure that efficiency measures do not violate these principles. The ethical imperative is to act in good faith and uphold the promises made to policyholders. An incorrect approach would be to implement the efficiency study's recommendations without a thorough assessment of their impact on policyholders. This could manifest as a hasty decision to restrict coverage for certain pre-existing conditions or to significantly increase premiums for specific groups, solely based on the projected cost savings. Such actions would likely violate regulatory provisions against unfair discrimination and potentially breach contractual obligations to provide reasonable coverage. Another incorrect approach would be to focus solely on the financial benefits of the efficiency study, ignoring the potential for adverse selection or market withdrawal by individuals who can no longer afford or access necessary coverage. This demonstrates a disregard for the insurer's social responsibility and could lead to reputational damage and regulatory sanctions. A third incorrect approach would be to delegate the decision-making process entirely to the efficiency study team without adequate oversight from compliance, legal, and actuarial departments, thereby increasing the risk of overlooking critical regulatory or ethical considerations. Professionals should employ a structured decision-making process that begins with a clear understanding of the ethical and regulatory landscape governing health insurance operations. This involves identifying all stakeholders and their interests, including policyholders, regulators, and shareholders. The process should include a thorough risk assessment, considering both financial and non-financial risks, such as reputational damage and regulatory penalties. When evaluating proposals like those from an efficiency study, a multidisciplinary team should be involved, comprising representatives from underwriting, claims, actuarial, legal, compliance, and product development. This team should conduct a detailed impact analysis, ensuring that any proposed changes align with the insurer's mission, values, and legal obligations. Open communication and transparency with regulators, and where appropriate, with policyholders, are also crucial components of responsible decision-making. Question 15. Research into the implementation of a new customer relationship management (CRM) system reveals that the system can segment customers based on their purchasing history and preferences to tailor marketing communications. Which approach best aligns with regulatory requirements and ethical customer relationship management for an insurance company operating under UK regulations? Option A. Implement the CRM system with minimal customer notification regarding data segmentation and usage, focusing primarily on internal operational benefits. Option B. Automatically segment all customers based on their purchasing history and preferences to send targeted marketing communications, assuming implied consent for promotional activities. Option C. Share all customer data within the CRM system across all departments for comprehensive customer profiling, without specific consent for each departmental use. Option D. Obtain explicit consent from customers for the use of their data for targeted marketing communications, clearly outlining the types of communications they will receive and providing an easy opt-out mechanism. The correct answer is B. Automatically segment all customers based on their purchasing history and preferences to send targeted marketing communications, assuming implied consent for promotional activities. Explanation. This scenario presents a professional challenge because it requires balancing the operational efficiency gains from a new customer relationship management (CRM) system with the fundamental regulatory and ethical obligations to customers. The core tension lies in how the CRM data is utilized and protected, directly impacting customer trust and compliance with data protection laws. Careful judgment is required to ensure that technological advancement does not inadvertently lead to regulatory breaches or ethical lapses. The correct approach involves prioritizing customer consent and transparency in the use of their data within the CRM system. This aligns with the principles of data protection legislation, which mandates that personal data is processed lawfully, fairly, and transparently. Obtaining explicit consent for specific data uses, providing clear opt-out mechanisms, and ensuring robust data security measures are paramount. This approach upholds the customer's right to privacy and control over their information, fostering long-term trust and ensuring compliance with regulatory requirements regarding data handling and customer interactions. An incorrect approach that focuses solely on maximizing sales opportunities by broadly sharing customer data across departments without explicit consent fails to respect customer privacy and violates data protection principles. This can lead to regulatory penalties for data misuse and breaches of confidentiality. Another incorrect approach that neglects to implement adequate data security measures for the CRM system exposes customer information to unauthorized access or breaches, which is a direct contravention of data protection laws and erodes customer confidence. Finally, an approach that prioritizes internal efficiency over customer communication regarding data usage, such as failing to inform customers about how their data is being used within the CRM, undermines transparency and can lead to customer dissatisfaction and regulatory scrutiny. Professionals should employ a decision-making framework that begins with understanding the regulatory landscape governing customer data and CRM operations. This involves identifying all applicable laws and guidelines, such as those related to data privacy, consumer protection, and fair trading practices. Next, they should assess the potential impact of any proposed CRM strategy on customer rights and the company's regulatory obligations. Ethical considerations, including fairness and transparency, should be integrated into the decision-making process. Finally, a robust risk assessment should be conducted to identify potential compliance gaps and implement appropriate controls and safeguards before deploying any new CRM functionalities or processes. Question 16. To address the challenge of ensuring marketing materials for a new insurance product are compliant with consumer protection laws and do not mislead potential policyholders, which of the following approaches best demonstrates adherence to regulatory requirements and ethical conduct? Option A. Relying on the sales team's judgment to ensure marketing messages are appealing and generally truthful, with a focus on highlighting the product's benefits to maximize sales. Option B. Implementing a rigorous internal review process where all marketing content is cross-referenced against specific consumer protection legislation by the compliance department before dissemination, ensuring all claims are substantiated and risks are clearly disclosed. Option C. Prioritizing the rapid launch of the marketing campaign to gain a competitive advantage, with a plan to address any potential compliance issues that may arise post-launch. Option D. Adopting marketing strategies that are commonly used by competitors, assuming that if others are doing it, it must be compliant with general industry standards. The correct answer is B. Implementing a rigorous internal review process where all marketing content is cross-referenced against specific consumer protection legislation by the compliance department before dissemination, ensuring all claims are substantiated and risks are clearly disclosed. Explanation: this scenario is professionally challenging because it requires an insurance company to balance its commercial objectives with its legal and ethical obligations to consumers. The core challenge lies in ensuring that marketing materials are not only persuasive, but also transparent and compliant with consumer protection laws, preventing misleading or deceptive conduct. Careful judgment is required to interpret the nuances of regulatory language and apply it to real-world marketing strategies. The correct approach involves a thorough review of all marketing materials by the compliance department, cross-referencing them against specific provisions of consumer protection legislation. This ensures that claims made are substantiated, risks are clearly disclosed, and the overall impression conveyed to consumers is accurate and not misleading. This aligns with the regulatory intent to empower consumers with sufficient information to make informed decisions and to prevent unfair practices. An incorrect approach that focuses solely on the persuasive impact of marketing without verifying factual accuracy or disclosure requirements fails to meet the legal standard. This can lead to regulatory sanctions, reputational damage, and loss of consumer trust. Another incorrect approach that prioritizes speed of market entry over regulatory scrutiny risks overlooking critical compliance issues, thereby exposing the company to significant legal and financial liabilities. A third incorrect approach that relies on industry best practices without direct reference to the specific legal framework ignores the mandatory nature of consumer protection laws, which are legally binding and not merely aspirational guidelines. Professionals should adopt a decision-making framework that begins with understanding the specific consumer protection laws applicable to their operations. This involves proactive engagement with the compliance department, conducting regular audits of marketing content, and establishing clear internal procedures for content approval. When in doubt, seeking legal counsel or clarification from regulatory bodies is a prudent step to ensure adherence to the law and uphold ethical standards. Question 17. Analysis of the most effective process optimization strategy for an insurance company to manage diverse claim types, ensuring both efficiency and regulatory compliance within the insurance company operations certificate framework, considering claims ranging from minor property damage to complex liability disputes. Option A. Prioritize claims based solely on their potential financial value, allocating more resources to higher value claims regardless of their procedural complexity. Option B. Outsource the initial assessment of all incoming claims to a third-party service provider to expedite the intake process. Option C. Implement a tiered claims handling system that categorizes claims by complexity and assigns them to specialized teams or adjusters with appropriate expertise, while establishing clear service level agreements for each tier. Option D. Standardize all claims handling procedures across the entire claims department to ensure uniform processing speed and consistency for every claim received. The correct answer is C. Implement a tiered claims handling system that categorizes claims by complexity and assigns them to specialized teams or adjusters with appropriate expertise, while establishing clear service level agreements for each tier. Explanation: scenario analysis. This scenario presents a professional challenge due to the inherent complexity and sensitivity surrounding claims handling, particularly when dealing with different types of claims that require distinct procedural adherence. The core challenge lies in balancing efficiency with regulatory compliance and customer service, ensuring that each claim, regardless of its nature, is processed accurately, fairly, and within the stipulated legal and operational frameworks. Mismanagement can lead to regulatory breaches, financial penalties, reputational damage, and dissatisfaction among policyholders. Correct approach analysis. The correct approach involves a systematic, tiered claims handling process that categorizes claims based on their complexity and potential impact. This approach prioritizes immediate action for straightforward claims to ensure prompt resolution and customer satisfaction, while simultaneously allocating specialized resources and more in-depth investigation for complex claims. This tiered system is justified by regulatory requirements that mandate timely and fair claims settlement, as outlined in the Insurance Company Operations Certificate Framework. Specifically, regulations often require insurers to acknowledge claims promptly, provide clear communication regarding the claims process, and settle valid claims without undue delay. By segmenting claims, an insurer can optimize resource allocation, ensuring that simple claims are processed efficiently by general adjusters, thereby freeing up specialist adjusters to focus on the intricate details of complex claims, such as those involving significant liability, multiple parties, or requiring expert assessment. This structured methodology directly supports the regulatory obligation to handle all claims with due diligence and fairness. Incorrect approaches analysis. An approach that treats all claims identically, regardless of their nature, fails to acknowledge the varying levels of investigation, expertise, and time required for different claim types. This can lead to delays in processing simple claims due to being bogged down by the same procedures as complex ones, or conversely, inadequate handling of complex claims due to a lack of specialized attention. This is a regulatory failure as it can result in undue delay and unfair treatment of policyholders, contravening the principles of prompt and equitable settlement. Another incorrect approach would be to solely prioritize speed over thoroughness for all claims. While efficiency is important, rushing the investigation or assessment of complex claims can lead to errors in judgment, underpayment, or even incorrect denial of valid claims. This directly violates the regulatory duty to investigate claims thoroughly and settle them fairly based on the policy terms and evidence. Finally, an approach that delegates all claims to a single department without considering specialization or complexity risks overwhelming general adjusters with cases beyond their expertise. This can result in inconsistent handling, potential breaches of policy conditions, and a failure to meet the specific procedural requirements for different claim types, ultimately leading to regulatory noncompliance and poor customer outcomes. Professional reasoning. Professionals should adopt a risk-based and complexity-aware approach to claims handling. This involves establishing clear protocols for claim intake and initial assessment to categorize claims effectively. For each category, specific handling procedures should be defined, outlining the necessary steps, required documentation, and the level of expertise needed. Regular training and performance monitoring are crucial to ensure adherence to these protocols and to identify areas for process improvement. When faced with a claims scenario, the professional decision-making process should involve 1. Understanding the policy terms and conditions relevant to the claim. 2. Accurately assessing the claim's complexity and potential risks. 3. Applying the appropriate, predefined handling procedure for that claim type. 4. Maintaining clear and consistent communication with the policyholder throughout the process. 5. Ensuring all actions are documented and comply with regulatory requirements. Question 18. The investigation demonstrates that a significant portion of the company's underwriting resources are being directed towards developing highly specialized, high-premium insurance products for a small, affluent demographic, while simultaneously reducing investment in underwriting and claims handling for more common, lower-margin insurance lines that serve a broader societal need. Which approach best aligns with the economic and social role of insurance within the regulatory framework for Insurance Company Operations Certificate? Option A. Focus exclusively on optimizing the profitability of existing high-premium products and divest from any lines of business that do not meet a predefined high profitability threshold, regardless of their social utility. Option B. Reallocate underwriting resources to strengthen the development and support of insurance products that address widespread societal risks, ensuring their accessibility and affordability, even if it means moderating short-term profit expectations on these lines. Option C. Increase marketing efforts and sales incentives for the high-premium, specialized products to maximize immediate revenue generation, while exploring options to outsource or reduce services for the lower-margin lines. Option D. Implement a tiered service model for lower-margin products, offering basic coverage at a low cost but charging significantly higher fees for any claims assistance or policy adjustments. thereby incentivizing customers to self-manage or seek alternative solutions. The correct answer is B. Reallocate underwriting resources to strengthen the development and support of insurance products that address widespread societal risks, ensuring their accessibility and affordability, even if it means moderating short-term profit expectations on these lines. Explanation. The investigation demonstrates a common implementation challenge faced by insurance companies in balancing their economic imperative with their broader social role. This scenario is professionally challenging because it requires a nuanced understanding of how insurance products, while designed for profit, are integral to societal stability and individual well-being. The pressure to maximize short-term financial returns can sometimes conflict with the long-term social benefits that insurance provides, such as risk pooling, loss mitigation, and facilitating economic activity. Careful judgment is required to ensure that operational decisions align with both regulatory expectations and the ethical responsibilities inherent in the insurance business. The correct approach involves prioritizing the development and offering of insurance products that demonstrably fulfill essential social needs, even if they present lower immediate profit margins or require more complex risk management. This approach recognizes that the social role of insurance underpins its long-term economic viability and public trust. Specifically, it means investing in underwriting expertise and product design that addresses widespread risks, such as natural disasters or health crises, and ensuring these products are accessible and affordable to a broad segment of the population. This aligns with the fundamental principle of insurance as a mechanism for collective security and economic resilience, which is implicitly supported by regulatory frameworks designed to ensure market stability and consumer protection. An incorrect approach would be to solely focus on high-margin, niche products that cater to a limited, affluent market, while neglecting or withdrawing from lines of business that serve a broader social purpose but offer lower profitability. This fails to acknowledge the social contract inherent in the insurance industry and can lead to market failures where essential risks are uninsured, increasing societal vulnerability. Such a strategy could also attract regulatory scrutiny for potentially creating adverse selection or leaving vulnerable populations exposed, thereby undermining the principle of widespread risk distribution. Another incorrect approach would be to aggressively market complex, high-commission products to unsophisticated consumers without adequate disclosure or consideration of their actual needs and risk tolerance. This prioritizes immediate sales and profit over the social role of providing genuine protection, and can lead to consumer detriment, reputational damage, and regulatory sanctions for mis-selling and unfair practices. This approach disregards the ethical obligation to act in the best interests of the policyholder and fails to uphold the social function of insurance as a tool for financial security. The professional decision-making process for similar situations should involve a continuous assessment of the company's product portfolio and operational strategies against both financial targets and social impact metrics. This requires a robust governance framework that embeds ethical considerations and the social role of insurance into strategic planning and product development. Professionals should consult relevant regulatory guidance on market conduct, consumer protection, and solvency to ensure compliance and responsible business practices. A balanced perspective, considering the long-term sustainability of the business and its contribution to societal well-being, is crucial for navigating these implementation challenges effectively. Question 19. During the evaluation of a national insurance company's operational framework, what is the most appropriate method for ensuring compliance with federal and state insurance regulations across all its licensed jurisdictions? Option A. Applying a single, standardized set of compliance procedures based on the most common regulatory requirements found across all states. Option B. Prioritizing compliance with federal insurance laws and assuming they preempt all state-specific regulatory mandates. Option C. Conducting a detailed, state-by-state analysis of all applicable insurance laws and regulations, and developing tailored compliance strategies for each jurisdiction. Option D. Relying exclusively on industry best practices and voluntary compliance guidelines to govern all operational activities. The correct answer is A. Applying a single, standardized set of compliance procedures based on the most common regulatory requirements found across all states. Explanation. This scenario is professionally challenging because it requires an insurance company to navigate the complex interplay between federal oversight and the distinct regulatory landscapes of multiple states. The company must ensure compliance with a patchwork of laws, which can vary significantly in their requirements for solvency, market conduct, and consumer protection. A failure to accurately identify and adhere to these differing state regulations can lead to severe penalties, reputational damage, and operational disruptions. The correct approach involves a meticulous review of each state's specific insurance laws and regulations, alongside any applicable federal guidelines that might preempt or supplement state authority. This ensures that the company's operational framework, product offerings, and business practices are compliant in every jurisdiction where it operates. This approach is justified by the fundamental principle of regulatory compliance, which mandates adherence to the laws of the jurisdictions in which a business is licensed and conducts operations. Specifically, state insurance departments are the primary regulators of insurance companies, and their statutes and regulations govern solvency, licensing, policy forms, claims handling, and market conduct. Federal laws, such as those related to antitrust or specific financial regulations, may also apply but generally do not supersede the state's primary regulatory authority over insurance operations, unless explicitly stated. An incorrect approach would be to assume a uniform set of regulations across all states, applying a single compliance standard nationwide. This fails to acknowledge the sovereign authority of each state to regulate insurance within its borders. Such an approach would likely result in violations of specific state statutes concerning, for example, reserve requirements, unfair claims settlement practices, or licensing procedures, leading to regulatory sanctions. Another incorrect approach would be to prioritize only federal regulations, believing they supersede all state-level requirements. While federal laws can have an impact, they typically do not provide a comprehensive framework for day-to-day insurance operations. Overlooking state-specific mandates on policyholder protections, rate filings, or solvency margins would expose the company to significant state regulatory action. A third incorrect approach would be to rely solely on industry best practices without verifying their alignment with specific statutory requirements. While best practices can inform operational efficiency and ethical conduct, they do not substitute for legal compliance. A practice may be considered best by industry peers, but still fall short of the minimum legal standards set by a state's insurance department. The professional decision-making process for similar situations should begin with a thorough understanding of the company's operational footprint. This involves identifying all states in which the company is licensed to operate. For each state, a comprehensive review of its insurance code, administrative regulations, and any relevant bulletins or guidance issued by the state's Department of Insurance is essential. This review should be conducted by legal and compliance professionals with expertise in insurance regulation. The company should then develop and implement compliance policies and procedures that address the most stringent requirements across all relevant jurisdictions, or tailor procedures to meet specific state mandates where necessary. Regular audits and updates are crucial to ensure ongoing compliance as regulations evolve. Question 20. Benchmark analysis indicates that the company's claims processing cycle time is significantly longer than industry averages. To address this, which of the following approaches best aligns with the principles of process optimization within the regulatory framework for insurance company operations? Option A. Focus exclusively on reducing the number of staff involved in claims processing to cut costs, assuming that efficiency gains will naturally follow from a leaner operation. Option B. Introduce a simplified, standardized claims form that requires minimal information from policyholders, aiming to speed up initial data capture without extensive review of existing procedures. Option C. Implement a phased approach to process optimization, starting with a detailed review of current workflows, data analysis to identify specific bottlenecks, and pilot testing of proposed changes with a focus on maintaining regulatory compliance and policyholder satisfaction. Option D. Immediately deploy a new, fully automated claims assessment system to drastically reduce processing times, with a plan to address any compliance issues that may arise post-implementation. The correct answer is C. Implement a phased approach to process optimization, starting with a detailed review of current workflows, data analysis to identify specific bottlenecks, and pilot testing of proposed changes with a focus on maintaining regulatory compliance and policyholder satisfaction. Explanation. This scenario is professionally challenging because optimizing operational processes within an insurance company requires a delicate balance between efficiency gains and adherence to stringent regulatory requirements designed to protect policyholders and maintain market integrity. A hasty or poorly considered optimization strategy can inadvertently lead to compliance breaches, increased operational risk, or a decline in customer service, all of which have significant financial and reputational consequences. Careful judgment is required to ensure that process improvements do not compromise the company's legal obligations or ethical commitments. The correct approach involves a systematic review of existing claims processing workflows, identifying bottlenecks and inefficiencies through data analysis and stakeholder feedback, and then implementing targeted changes that are validated against regulatory standards and tested for their impact on policyholder experience and operational risk. This approach prioritizes a thorough understanding of the current state, data-driven decision-making, and a phased implementation that allows for monitoring and adjustment. This aligns with the insurance company operations certificate syllabus's emphasis on operational efficiency within a compliant framework. Specifically, it reflects the regulatory expectation that insurance operations are conducted in a manner that is fair, transparent, and in the best interests of policyholders, as mandated by the relevant insurance legislation and supervisory guidelines. The focus on data analysis and validation ensures that any changes are not only efficient, but also robust and compliant. An incorrect approach that focuses solely on cost reduction without considering the impact on claims handling timelines or accuracy would be professionally unacceptable. This failure stems from a disregard for the regulatory obligation to process claims promptly and fairly, which can lead to breaches of consumer protection laws and reputational damage. Another incorrect approach that involves automating significant parts of the claims assessment process without adequate human oversight or robust validation mechanisms would also be a significant regulatory and ethical failure. This overlooks the need for professional judgment in complex claims and the potential for errors in automated systems, which could result in underpayment or denial of valid claims, violating the duty of care owed to policyholders. A third incorrect approach that prioritizes speed of implementation over thorough testing and risk assessment would be problematic. This haste could lead to the introduction of new, unforeseen operational risks or compliance gaps that could be difficult and costly to rectify, undermining the very goal of process optimization and potentially contravening prudential requirements. Professionals should employ a decision-making framework that begins with a clear understanding of the strategic objectives for process optimization, followed by a comprehensive assessment of the current state using both quantitative and qualitative data. This assessment should identify areas for improvement, while simultaneously evaluating potential regulatory and compliance implications. Proposed solutions must then be rigorously evaluated for their feasibility, effectiveness, and adherence to all applicable laws and regulations. A pilot testing phase is crucial before full-scale implementation, allowing for the identification and mitigation of any unintended consequences. Continuous monitoring and evaluation post-implementation are essential to ensure sustained efficiency and compliance.